When meeting with new people that have reached out to our firm, there's some common questions that we get around required minimum distributions. How to reduce your required minimum distribution, how to pay less tax on your RMD, or another one that actually kind of falls with these two, and I'll show you how here in a second, is that they're giving to charities, but not enough to deduct it on their taxes. So they're wondering, is there a way to still give to charity, but get a tax deduction for what they're giving to charity? And so today I'm going to walk you through a sample case, a hypothetical scenario here that shows a strategy that you can utilize that helps to potentially solve all three of these questions that I've went over. So here's what we're going to do. We're going to talk about Bob and Peggy sample. Bob and Peggy sample here, very straightforward scenario, because I just want to, again, give you a very straightforward scenario here. The main thing is to show you the strategy to help them reduce their RMDs, reduce the taxes on their RMDs, still give to charity, and get a deduction on their taxes. So straightforward scenario here. Bob and Peggy each have $750,000 in their IRAs, so they have $1.5 million total. Being age 73, guess what? This is the year that they've got to start taking their required minimum distributions on that $1.5 million. Now, just in case you're wondering, they have a residence of $500,000, and I'm going to show you here they don't have a mortgage. So sometimes people think, oh, hey, if I have that mortgage, well, then there's a potential write-off there. I just want to kind of, again, keep things very simple here. They don't have mortgage, so they don't have mortgage interest as a potential write-off on their taxes. Now, the other thing here, right, so they're going to be taking required minimum distributions. But the other thing in regards to this hypothetical scenario for Bob and Peggy is they give $5,000 a year to charities, whether it's to their favorite charities or local church or whatever you might be giving to. They give about $5,000 a year. And for them, they're not able to deduct that $5,000 on their taxes. And I'll show you why here in a second. So what's the strategy then that we can utilize to help answer all three of these questions and get them a deduction on their taxes? And that's qualified charitable distributions. And I'm going to show you the power of this strategy as we go through Bob and Peggy's sample here. So let's walk through their scenario and their current tax scenario based on just how they're managing things today. So take a look here. We're going to say they don't have any wage income, they're retired. And again, just keeping things simple. No interest income, no dividends, they don't have a taxable account. And then here we go, IRA distributions. They each have, based on that $1.5 million, $28,302 that they have to take out from their accounts, from that $750,000. Okay, so that brings us to $56,604 of IRA distributions. And they each have Social Security coming in. Just to give you an idea, Bob's got $36,000, Peggy has $30,000. Now, because of the IRA distributions, now their Social Security becomes taxable. Something to keep in mind as I'm going to show you the strategy and the impacts it has on helping you to reduce not only your RMDs, but your taxes. And again, keeping things simple, they don't have any long-term gains or short-term gains. And you may ask, well, if they're given $5,000, now to some people that might seem like a little, to some people that might seem like a lot. But either way, in your scenario here, why aren't they able to deduct that on their taxes? So if we go down here to itemized deductions, now because they own their property, let's just say they have property taxes of $8,000. And then scrolling down here, they give to the charity, as I mentioned, $5,000 a year. Well, if we add that up, that's $13,000. Now, if I show you here and we take this and say, say they were to take the itemized deduction. The itemized deduction in their scenario would be $13,000. However, what's the most optimal deduction for them in their scenario? And it's the standard deduction, $32,300. So for them, all of their itemized deductions would have to exceed $32,300 for them to then actually be utilizing the charitable deductions or mortgage interest or whatever it might be on their taxes. So what am I saying here is that the standard deduction far exceeds all of their itemized deductions. They're just going to get the standard deduction. You might say, well, hey, that's great. They're getting way more than what they were giving to charity anyway. So, I mean, great. However, there's actually a way for them to give to charity and take advantage of it, and that is the QCD process, Qualified Charitable Distribution. Now, let me just finish here, and then I'll explain the QCD process. So, in the end, as you can see here, Bob and Peggy sample, their estimated tax, again, in this scenario, $7,824 for that year. So, let's just kind of say, what if they were to take a different approach? And by different approach, I mean we're just going to change one thing. And that one thing is they're going to do a qualified charitable distribution instead of giving to a charity from their checking or savings account. How does a qualified charitable distribution work? Well, what Bob or Peggy or both would do is they're going to give to the charity directly from their IRA account instead of giving it from their checking account. So what's the difference in this? Well, the IRA custodian's actually going to write the check to the charity versus the money coming to their checking account and then going out to the charity. Well, what does that mean? Well, what it means then is they are actually able to, when they do that, they don't have to claim what they've given to that charity as income on their income taxes. They don't have to treat that like part of their required minimum distribution. It just went to the charity. Therefore, it's technically going to that charity tax-free. But it makes a big difference on their taxes, and I'll show you that here in a second. Now, who would be eligible to do a qualified charitable distribution? Based on current IRS rules, and again, for all of this, you should really talk to your financial professional as well as your tax preparer. But for all of this, and based on current IRS rules, make sure you always look for updates. Right now, you can do this at age 70 and a half or older. It must come from it should come from an IRA, and then based on current laws, you're able to do up to $105,000 per taxpayer. Now, big note on this is that your IRA custodian does not report your qualified charitable distribution. So as I go through this, I'll explain to you what I mean about this. But what does that mean? Then it means that you must keep track and report it to your tax preparer, or if you are your own tax preparer, make sure that you're keeping track and then filing your taxes accordingly. So let's walk through the scenario here by implementing the qualified charitable distributions strategy. So I'm going to kind of got it made up here a little. We're going to add in our QCD scenario. Let's go back to the top, and I'm going to show you all of the differences here that we're going to figure in. So again, same things. Like I said, we're only changing one thing, but you'll see it's going to save them in taxes. So right here, their IRA distributions. Now, instead of giving, again, taking that to their checking account, we're going to do something different. We're going to say, what if Bob actually gave, and again, that was supposed to be $28,302. What if Bob gave directly from his IRA here? And so we're going to say, instead of $28,302, we have $23,302, so $5,000 that he's giving directly from his IRA. We're going to hit close there. And so now you see we have $5,000 less of taxable income. That's why I said you have to keep track. Your IRA custodian is not going to report this to the IRS or to your tax preparer. You have to keep track, keep the forms, keep what you're doing, the QCD forms, so that way you can give them to your tax preparer and show them the amount that you should be taking off of the RMD that's coming out of your account, or just the money that you're taking out of your IRA account. So you need to show them that and keep that documentation so you can also prove it to the IRS. All right, so what do we have here? Well, now we have less income coming in. And if you go down a little bit, right, same Social Security, but guess what? Now because we have less income coming in, we have less taxable Social Security. So we continue to scroll down. Everything else is the same, right? We're still got the same $8,000 of property taxes, okay? But instead of giving to charity from our checking account, we use the Qualified Charitable Distribution process. So we gave it from our IRA account above. And take a look at this. Again, we're still getting the standard deduction. So you might have said before, well, hey, they're getting a better deduction than what they would have anyways. Well, guess what? We're still getting the same standard deduction, but now we got another benefit because we reduced our income up above. And because of all of that, you can see here, it's reduced the taxable income almost by $10,000. So they gave $5,000 to charity, but because of the taxes on Social Security and how that's taxed, they've reduced their taxable income now by almost $10,000, a little bit shy on that. And then they've also reduced their total tax. If we look at the delta here and scroll all the way down, you can, here we go, taxable income. They've reduced that by $9,250. And just by thinking differently, using a different process, they've now reduced their total tax by $1,110. So, same scenario, doing all the same things with all the same money, just changing up one thing of how they give to charity. They've reduced the required minimum distribution. They've reduced the taxes on the required minimum distribution. And now they're getting a tax deduction for the amounts that they're giving to charity. So hopefully this helped you out, helped you understand qualified charitable distributions a little bit more and the power of the strategy of QCDs. And if so, and you've enjoyed this video, feel free to subscribe to our YouTube channel. We're coming out with new videos each and every week to talk about retirement topics like how to reduce the taxes on your IRAs and 401ks, how to help maximize your Social Security, and how to just build a retirement plan to help give you confidence for your future. Again, subscribe to our YouTube channel, and I look forward to seeing you on our next video. Have a great day.